On November 18, 2021, something strange happened in the fast food world. A salad company walked onto Wall Street and was instantly worth more than $5 billion. Not a burger chain, not a pizza empire, a salad brand. Sweetgreen wasn't just selling food, it was selling an idea. Healthy, modern, tech-driven, effortless. The kind of company that felt perfectly designed for its moment. Investors loved it, customers loved it. The market believed this was the future of eating. Fast forward a few years, and that future started to crack. The stock collapsed, layoffs followed, losses piled up, and the company that once looked unstoppable began fighting just to stay relevant. The real problem was quieter, more basic, and it was hiding inside every single bowl they sold. To understand how Sweetgreen rose so fast and why it started falling just as quickly, we need to go back to the very beginning. Sweetgreen started in 2007, far from Wall Street hype and billion-dollar valuations. Three recent Georgetown University graduates, Jonathan Neiman, Nicholas Jammet, and Nathaniel Rue, were frustrated with the food around them in Washington, D.C. Everything nearby was fast, cheap, and unhealthy, or healthy, slow, and boring. So they asked a simple question: what if healthy food could be as fast as a burger? They didn't dream of global domination. They didn't talk about disruption. They just wanted fresh food, made quickly, with ingredients people could feel good about eating. From a college dorm room, they mapped out a small business built around salads, hot and cold, using ingredients sourced from local farmers. They raised $300,000 from 50 investors, not venture capital giants, just people who believed in the idea. In August 2007, they opened their first location. It was tiny, only 560 square feet, right near their university campus, but it worked. Sweetgreen grew slowly and carefully. No rush, no explosions, just steady expansion and a growing reputation for quality. What made the company special wasn't only the food, it was the feeling. Clean design, minimal branding, a sense that eating there meant something about who you were. Sweetgreen wasn't just feeding customers, it was selling a lifestyle. They leaned into that identity hard. They launched the Sweet Life Music Festival, blending food, music, and community. Sweetgreen became less like a restaurant and more like a cultural brand. For years, this approach paid off. Then, the venture capital money arrived. In 2013, Revolution Growth, led by AOL co-founder Steve Case, invested $22 million. By 2018, a massive $200 million funding round led by Fidelity pushed Sweetgreen's valuation past $1 billion. Sweetgreen wasn't just a restaurant anymore. It became a tech company that happened to sell food. By the early 2010 seconds, Sweetgreen wasn't just another fast casual restaurant. It was becoming a signal. Eating there said something about you. You cared about health, you cared about sustainability, you were busy, modern, and informed. That image mattered more than most people realized. Investors noticed it first. In 2013, Sweetgreen landed a major boost when Revolution Growth, led by AOL founder Steve Case, invested $22 million. That money didn't just help them open more stores. It validated the idea that Sweetgreen wasn't really a restaurant at all. It was a brand, a platform, maybe even a tech company. By 2018, that belief exploded. A $200 million funding round led by Fidelity pushed Sweetgreen's valuation past $1 billion, official unicorn status. At this point, the story was irresistible. Here was a company selling healthy food in a country struggling with obesity. Here was a brand that cared about local farmers and the environment. Here was a business built for millennials, powered by apps, data, and delivery. Sweetgreen leaned fully into that identity. They invested heavily in digital ordering, long before it became standard. Customers could order ahead, customize everything, and skip the line entirely. It worked. By 2020, more than half of Sweetgreen's revenue came through its own app. That stat alone made investors excited. This wasn't just lunch, this was recurring behavior, data-rich, predictable, scalable. By the time the pandemic hit, Sweetgreen had over 140 locations and a loyal base of urban white-collar workers. When offices shut down, delivery helped cushion the blow. And when markets rebounded in 2021, Sweetgreen looked perfectly positioned, so the founders made their move. The company's valuation soared past $5 billion in a single day. On paper, it was a dream debut. Wall Street saw a future where Sweetgreen spread to every major city, then every suburb, then maybe every country. A global health-focused giant, powered by software, culture, and automation. But beneath the celebration, a quiet problem was already forming. By the time Sweetgreen rang the opening bell on Wall Street, the story felt complete. Healthy food, smart tech, loyal customers. A brand people loved to be seen with. The stock surge on day one seemed to confirm it. This wasn't just a restaurant chain anymore. It was a movement that had gone public. But markets don't care about stories for long. They care about results. Less than a year after the IPO, the first warning signs appeared. In August 2022, Sweetgreen quietly announced layoffs. 5% of its corporate staff were gone. At the same time, the company cut its financial forecast, blaming slower office returns after the pandemic. That explanation made sense on the surface. Fewer people commuting meant fewer lunchtime orders. But underneath that excuse was a deeper problem that had been there all along. Sweetgreen's customer base was narrow. The brand was built around well-paid urban professionals, people who didn't mind spending $15 to $20 on lunch because it fit their identity. Healthy, busy, image-conscious. But when inflation hit and work from home became permanent for many, that group started pulling back. Suddenly, Sweetgreen wasn't a daily habit, it was an occasional treat. And when customers came less often, the price became harder to justify. The company tried to stay ahead of the problem by leaning even harder into technology. Just before its IPO, Sweetgreen had made a bold bet. It acquired a robotics startup called Spice, founded by MIT graduates, with the goal of automating food prep. The vision was ambitious: fully automated kitchens, faster service, lower labor costs, a restaurant model built for scale. They called it the Infinite Kitchen. In theory, it was the future of fast food. In reality, it was slow, expensive, and far from ready. When the first Infinite Kitchen opened in Illinois in 2023, it didn't deliver the breakthrough investors were hoping for. It didn't meaningfully cut costs, and it didn't fix the core issue. People still thought the salads were too expensive. Meanwhile, new problems kept piling up. Customers noticed the changes before investors did. Complaints about smaller portions started spreading. Quality felt inconsistent. The brand that once stood for abundance and freshness now felt tighter, more cautious. In August, the stock dropped more than 27% in a single day after weak earnings. Another round of layoffs followed. Behind the scenes, Sweetgreen was retreating. Expansion slowed, store openings were cut back, the loyal customers were real, the brand was real, but it wasn't universal. And without breaking into the mainstream, the math simply didn't work. By the time Sweetgreen slowed its growth plans and hinted at menu changes that once would have felt unthinkable, the transformation was clear. This wasn't a rocket ship anymore. It was a company trying to prove it deserved to exist. And that raises the question no one wanted to ask at the IPO. Was Sweetgreen ever built to last? Or was it built for a moment that already passed? As Sweetgreen tried to navigate its challenges, it pinned its hopes on automation, a bold experiment meant to revolutionize the restaurant industry. In August 2021, the company acquired Spice Robotics, a Boston-based startup founded by MIT graduates. The vision was ambitious: robotic kitchens that could prepare salads faster, more consistently, and cheaper than human staff. The first Infinite Kitchen opened in Naperville, Illinois, in May 2023. The robots weren't as fast or as cheap as expected. Instead of solving the problems of labor costs and consistency, automation became another complex layer to manage expensive, slow, and sometimes unreliable. This struggle highlighted a larger truth about Sweetgreen's business. It was caught between being a tech company and a restaurant company. The focus on automation, mobile apps, and futuristic innovations distracted from the core operations, keeping stores running smoothly, serving customers consistently, and maintaining food quality. Meanwhile, the market grew impatient. Investors and analysts watched closely. Even with innovative robotics and tech-driven solutions, Sweetgreen still faced the hard reality of economics. Their $16, $20 salads were expensive for many people, and the post-pandemic cost of living crisis meant fewer customers were willing or able to pay a premium. Sweetgreen's story is a modern cautionary tale. From its early days as the Starbucks of salad to a multi-billion-dollar IPO, the company captured imagination, media attention, and investor dollars. Yet, the challenges of pricing, scaling, and balancing tech with core operations remind us that a good idea isn't always a guaranteed success. The question now is simple: can Sweetgreen complete its pivot and reclaim its place as a leader in the fast casual market? The answer depends on adaptation, resilience, and a return to fundamentals. And for everyone watching, it's a reminder that in business, just like in life, success isn't permanent, and learning from setbacks is what separates companies that survive from those that fade away.